Welcome to Financial Jaga Jaga.
So another impact we're expecting to see is increase in bond rates, right? Bonds are another type of investments, federal government bonds, right? Rates increased, right? And what I mean by that is in the secondary market where traders just trade to make money, we saw rates go up. People were looking to buy bonds at high levels, bonds that were previously trading at, say, maybe a particular bond. Let me use the 2042 bond as an example. This was previously being traded at, say, 12.9, 12.92, 12.93, 12.94. First of all, when the inflation figures came out, the auction happened that same day, and this bond rate went to 13%. Now, after the NCB auction, what we saw in the market, this same bond was now traded at 13 points. People were bidding for this bond at 13.4, 13.5. Like, it was so interesting to see that, these things that you read about in the books, you're actually seeing it play out in the market. So, increase in bond rates. Now, if bond rates are increasing, it means that you as an investor, you can actually get bonds at higher rates than you could previously get them before. So the way this kind of things play out, more people will start demanding for bonds, and then the law of demand and supply. If the demand is so much, the rates might start trending down again, or maybe not as low as it used to be. Now, another impact that we're expecting to see as a result of this increase in interest rates is we're expecting to see that this would affect the stock market. Now, just thinking about it logically, right? I've already said that treasury bills and bonds rates have gone up. So if treasury bills and bonds, which are considered relatively safe investments, because federal government bonds now, local currency bonds and treasury bills now, these are safe investments because worst case scenario, the government is going to print money to pay you back. So they have a very low risk factor. If these low risk investments are yielding high returns, then a rational investor who has put money in the stock market might begin to rethink their investment choice and say, what's the point of investing in stocks, which is risky, in quotes? What's the point of investing in the stock market when I can just go and buy treasury bills and bonds at interesting levels? And so we might see what should normally happen in an efficient market is we might begin to see some investors move out of the stock markets to come into this fixed income space, which is treasury bills and bonds. Now, all things being equal, another impact that this kind of news should have is an improvement in the local currency, the exchange rates of Naira, because like I said, local government bonds and treasury bills rates have gone up. So foreign investors should be attracted to bring their money in and invest in all of these instruments. But a lot of factors would determine if this would actually happen. By that I mean, it's not just Nigeria that has increased interest rates in recent times. US has increased interest rates, Bank of England has increased interest rates, Bank of Canada has increased interest rates, European Bank has increased interest rates, even Ghana has increased. So at the end of the day, you need to ask yourself, will foreign investors really have that incentive to come to Nigeria? Because it's not just Nigeria that is offering maybe a higher interest rate. Other countries that are considered even developed economies are also increasing their interest rates. So even though under normal circumstances this should have led to foreign investors coming in, and when foreign investors come in, you have our foreign reserves go up, and this should lead to an improvement in our exchange rate. But we might not necessarily see that play out in the Nigerian space at this time, because this interest rate is more of consensus. It's not just Nigerian central bank that's taking rates up. So I really hope that you've learned one or two things and you're able to process the impact of this increase in interest rate. Like I said, the broad reasoning behind it is to tackle inflation. And watch my inflation video. I'll keep saying it, I'll keep drumming it to your ears. Watch my inflation video, because I really broke it down, the types of inflation, cost push, demand pull, what is monetary policy, what is this, what is that. Like, it's such an insightful video. I feel like I just breezed through commercial lending rates. I probably need to just say this before I end this video. Now, when commercial lending rates go up, right, that has like a ripple effect on the economy, because now businesses, manufacturers will go to banks and they are going to be able to get loans at high interest rates. Now, this means that many manufacturers who wanted to expand their businesses before might be discouraged, and so businesses might not scale up, right? And that would now impact the economy, the GDP. the employment rate, because if a business is not scaling up, they will not be able to employ more people. And so that is why, in as much as the logical thing to do when inflation starts jumping goes up, the central bank was a bit hesitant. This is not the first time inflation went up. They were a little hesitant. They had kept the rate stable for the longest time since September 2020, right? But because the inflation just kept rising, it just felt like, we have to do this. The reason is increasing interest rates. You're tightening the economy. So in as much as you're managing inflation, this economy is fragile. It needs to grow. You doing this means that people will not be able to get money. People will not be able to get loans at low levels, but they will be charged high interest rates. But I guess it's just a decision that the central bank had to make. I'm so happy. I hope you enjoyed this. Please leave a comment, share, comment. Please, I beg you. Thank you once again for staying tuned. Bye.